Stock market in China. High return opportunities with high risk. Hello and welcome to today's video. Today we are talking about the stock market of China and all the information about investment strategies. We've also picked out 4 specific stocks for you to put on your watch list. If you like this video, we appreciate a thumbs up and that you subscribe to our channel. The stock market in China includes the Shanghai and Shenzhen stock exchanges, the Shanghai Composite Index, and the SSE Composite Index are the main indices that measure the performance of the Chinese stock market. The Chinese stock market has experienced strong growth in recent years and is considered one of the fastest growing markets in the world. However, the market has also been subject to strong fluctuations in the past, with sharp price drops in 2015 and in 2018. The Chinese stock market is of great global importance due to the size and importance of the Chinese economy. Investors around the world are interested in Chinese stocks because China is considered one of the world's largest economies and plays an important role in the global economy. However, there are also challenges for investors looking to invest in the Chinese stock market. These include the lack of transparency of many companies, the regulation of the Chinese stock market, and the possibility of economic and political risks. There are some economic and political risks that can affect the Chinese stock market. Some of the most important risks are economic growth. China has experienced strong economic growth in recent years, but there is a risk of growth slowing due to factors such as rising debt and a slowdown in the global economy. Trade conflicts. China has faced trade conflicts with other countries, such as the US, in the past, and future trade conflicts could have an impact on the Chinese stock market. Regulation and political instability. The Chinese stock market is subject to government control, and political instability or changes in regulation may have an impact on the market. Financial and currency risks. Investors who invest in the Chinese stock market must also be concerned with currency risks and financial regulations that may affect trading in Chinese currencies and stocks. Lack of transparency. Some companies on the Chinese stock market have little transparency in terms of finances and corporate governance, which may cause investors to reconsider their investments. It is important to note that these risks do not necessarily result in a loss, but it is important to know and consider them before investing in the Chinese stock market. It is recommended to research current and trustworthy financial data and ask a financial advisor or experienced investor for advice before making any investment decisions. Besides the geopolitical tension, the collapse of the real estate market, and economic regulations of the economy by the government, investing in the Chinese stock market is a possibility of an investment that can be worthwhile, as the country has a very large growth potential. The Chinese economy is growing extremely, not only in terms of exports, but also in terms of increasing domestic consumption and the great potential that lies within. Compared to many other economies, the economy and GDP is not shrinking due to the corona crisis, inflation, and global stagnation. It is simply growing at a slower rate. What you should know and consider before investing in Chinese stocks. Often there are 2 different shares of a company on the Chinese stock market, one for domestic investors only, and one for foreign investors only. Furthermore, there are shares that are not tradable for foreigners at all. Logically, these shares often differ in value. The Chinese Central Bank, People's Bank of China, actively supports the Chinese stock market. Therefore, foreign investors should pay attention to these interventions as indices. For example, if you compare the Hang Seng China Enterprises Index with the Shanghai Composite Index in the Corona years, the difference could not be greater. The HSCEI shows the real picture of the economic situation in China, which shows the high indebtedness of the consumers, the vulnerable real estate market, the problems and consequences of the corona pandemic, and finally, the dangers of the extreme economic growth. The Shanghai Composite Index was stabilized after the relaxation of strict corona regulations. Chinese stock markets initially exploded. The HSCEI rose by a staggering 35% from October 2022 to December 2022, and the CSI 200 by a full 11%. Since then, this growth has stagnated again. Even if we as Westerners were of the opinion that the corona pandemic had hit us extremely and that major consequences would follow, in China, this had taken on a far greater scale, as in some cases, complete cities, metropolises, industrial centers, and ports were closed and cordoned off for days or even weeks after the disaster with the Chinese real estate company Evergrande Real Estate Group and the suspension of trading on the stock exchange. China's real estate market is down. The company owes mainly Chinese banks about $280 billion, with Evergrande being the second largest real estate company in the country. Representing the whole country, you should avoid investments in real estate stocks in any case, because the bankruptcy came in the wake of the increase in interest rates and the resulting impossibility of repayment, which affects the entire real estate market. Furthermore, the currency is also a big aspect you should consider before investing in China. One renminbi yuan is currently between 0.14 to 0.15 dollars in January of 2023. If you look at the exchange rate over the last 5 years, there has been extreme fluctuations in the exchange rate over the years. For example, if you hold a dividend-paying stock and the exchange rate is low right now, you have a low dividend payout. The same is true for the price of the stock if you are looking to sell. So you have a conflict between the need for quick trading and intervention and the volatile exchange rate of the currency. If the rate of the yuan rises, the Chinese currency will weaken. If the yuan falls in the exchange rate, the yuan will appreciate as a currency. On the fluctuation of exchange rates, so exactly in 2018 and 2019, can record the intensification of the trade war, the impact of economic losses from mid-2020 to the spring of 2022, and thus compensate for the disadvantages of currency appreciation through higher sales. Currently, the yuan currency is weakening again because many people hope for a stable dollar in times of crisis, and thus the currency of the USA is currently experiencing an appreciation. Furthermore, China is now deliberately pushing its currency down in order to support domestic growth by increasing exports. A selection of 4 specific Chinese stocks that could be exciting. However, the selection represents a snapshot of October 2022. 1. Alibaba as a stock to watch, as the online retailer has had to pay a hefty antitrust fine, and the company has faced tough regulations in Beijing due to its rising market power, as well as increasing international focus. The consumer-focused company is suffering from weakening global economy, corona regulations, as well as supply shortages. However, the share price decline and pricing may make the stock attractive for future investments after possible bottoming. 2. Tencent. A technology company had seen a decline of negative 39% to $459 billion in 2022. However, the company remains exciting as the company, which is rather unknown in Europe and the US, has a large market share in Asia and holds a broadly diversified supply slate as a holder of key patents and global investors. Again, don't get in until the company's future performance becomes clear. 3. Geely Automotive Holdings is a large Chinese automaker that has established a wide range of different models, with its majority stake in Swedish car brand Volvo, Swedish Polestar, and British Lotus. The company is broadly positioned. Geely is definitely a stock you should keep an eye on, despite its usual losses over the past 3 years. 4. China Southern Airline is the world's third largest airline and Asia's largest airline, with 635 aircraft and worldwide destinations. Profits are expected to be high, following the reassurance of tourism after the corona pandemic. However, the downward trend continues to prevail here as well, despite the almost unpredictable economic situations. Many analysts estimate that the Chinese stock market will be lucrative in 2023 and the following years. Some investment strategies recommend investing in the Chinese stock market, but always draw attention to the fact that with a very high return opportunity also comes a high risk. That was today's video about the Chinese stock market. Will you invest in China? Feel free to leave us your opinion below the video here. Thanks for watching.